Hey y'all, so today we're going to go over how to read an options contract. So I'm going to show you guys an option contract that I recently took, and we're going to break it down bit by bit. By the end of this video, which hopefully will be pretty short and concise, you will understand how to read an options contract. We're going to look at my Robinhood contract on the screen here. All right, so we're going to go over all of these screenshots, but let's first start off with the trade that I took so that we can better understand how to read the contract. Okay, so this was a NVDA trade. We had a gap up for the morning. I let it run a little bit, and then I decided to get in right at the top of this candle. So I got in right here where this crazy looking yellow arrow is. I drew that freehand, obviously. But I got in right here and I got in for a put. The reason why I got in for a put is because we hit resistance. Now, resistance wasn't marked with the resistance beam on my chart because we have actually never been at this point in the video before. We've never been in the 800s. So resistance is actually being built and created right now. But I could see and tell by the price action and candlestick movement that we were hitting resistance. So I got in right here with a put. So I got in at the top of this green candle here once we were starting to get rejected. You can see the rejection with that wick there. And then I decided to get out once we were bouncing off of the cloud, which is one of my favorite indicators. So once we started to bounce off of that, and this is the 10-minute time frame, I decided to get out. So it was a very quick in and out thing. I was only in the market for less than 40 minutes. Each of these candlesticks represents 10 minutes in the market. So now that we know what trade I took, let's look and see what the contract looks like for this exact trade. Okay, so this is on Robinhood. This is an example of what my failed order contract looks like for this trade. So it says I bought NVIDIA 680 put, which expires 3/8. This was a limit buy order. The position effect is open because that is when I opened the trade. The time was good for day. So if it didn't get filled for the day, it would automatically cancel the order and it wouldn't try to go through tomorrow. That's what good for day means. You can also do good until canceled. Good until canceled means that if the position doesn't get filled with the price that you set it for today, that day, then it will try again the next day and the next day until you actually manually cancel that order. So most of my positions, if not all of them, are good for day. And that's just the default setting on Robinhood. So I submitted this limit buy order, and limit buy order just means that I set the limit price and it needs to get filled at that price. If it doesn't hit that price again, then it's not going to get filled. That's what limit buy means. So that's the type of order I did. I submitted that on February 23rd at 9:46 a.m. Eastern Standard Time. So about 15 minutes after the market opens. I kind of let that candle run up a little bit before I got in, and I'm glad I did. I got one contract. The contract got filled at the price that I submitted it for, which was this limit price of $1.23. Now, you have to remember that this is an options contract, so you have to multiply that by 100 shares because one options contract is 100 shares of that stock. So you can either multiply this by 100. Oh, my writing is terrible on this. Or move the decimal place over 2 places to the right. Easiest for me to just visually move the decimal place over 2 places to the right. So that's what I do most of the time. So I paid $123 for this contract. That's why the total cost is $123.03. So Robinhood is now starting to showcase the micro commission or micro tax or micro fee, whatever you want to call it. They are now starting to showcase that in the options contracts. They used to not do that. They used to just say that they're taking a micro cut, a micro fee, but they wouldn't show it. But I have noticed over the past few months, they've started to actually show you how much they're charging you, which is good because that's transparent pricing. So in this case, Robinhood, which is my broker, charged me 3 cents for this option contract. So I paid a total of $123.03. And that's why it shows here regulatory fees, which is their cut, is 3 cents. Again, I put this trade in at 9:46. It also got filled at 9:46 a.m., so it pretty much got filled immediately. The price that I wanted to get it at, 123, is exactly what I got it for. So now we can move over here, and this is what you would see when the actual trade is open. When your position is open, you go in on Robinhood, and this is the screen that you will see. So this is a screenshot from when the trade was still open. I hadn't closed it yet. Again, I got the contract at 9:46, so this screenshot was taken at 9:59. So So not even 15 minutes later, I was already up 17% on this trade. I was up because if we go back over here to the actual trade, I got in here and we started to move down immediately on that next candle. So since I have a put, that means I'm making money when it goes down. And because of that, I was able to be up in my position already 17% in profit, not even 15 minutes after getting the contract. So you can see your today's return, which is how much you made on the day. And because this is the same day, my today's return is the exact same as my total return. If this was the next day, then it would be different. But since it was the same day, it's the same thing. I'm up 17.89%, which is $22 in this case. Up here at the top, it'll show you a concise version of the contract that you got. NVIDIA 680 put 145. That is how much the premium is currently. That's not what you got it at. That's what it is currently. Down here, it'll say your position. Number of contracts I got is 1. The current price is at 145. My average cost, which is the average cost that I got it in at. I got one contract, so the average cost is what I paid for that one contract. Now, if I were to get 3 contracts, maybe I bought this contract during 3 different time frames. And let's say I got one at $1.23, which again is $123. And then I bought another contract when it went to $1.18. And then I got another one when it went to $1.15. It would take the average price of all 3 contracts, and that it would be your average cost for what you are in that position at. So because I just got one contract, the average cost is what I bought that one contract for, which is $123, which is $123 of my money. Current price is $145. So if I sell it back to the market value is $145. So on this screen, it does the calculation of times 100 or move the decimal place over 2 places to the right for you, which is nice. So it shows you how much you will be able to sell it back to the market for, $145. I bought it on February 23rd. The expiration date is March 8th. It shows the NVIDIA break-even price, $678. I'm way in profit, way before it even hits the ballpark of the break-even price, and I go into more detail as to why that is in my course. But yeah, the NVIDIA break-even price kind of doesn't really matter because I'm in profit. So now it also shows the current NVIDIA price. It's currently trading for $805 per share, and then again we have the returns on my investment. With that being said, I went ahead and I sold this. So this screenshot was taken at 9:59. I decided to go ahead and sell it right away. This is my filled order for my position closing. So this is my position opening right here, and now this is my position closing. So this is a limit sell, meaning that I typed in the price that I wanted it to sell for, and if it did not hit that price, then it would not sell. The position effect is close. The time in force is good for day. Once again, if it did not hit that price for the day, it would not try to hit that price the next day. I would have to manually set up another sell order for the next day. It wouldn't automatically try. If it's good till canceled, it will automatically try until you manually cancel the order from going through. I submitted this on February 23rd at 9:59 a.m. The quantity is 1 because I only had one contract. The filled quantity is 1. So when I took the screenshot, it was at $145. I wasn't able to sell it at that price. I sold it at $1.42, which is $142. It got filled pretty much immediately for the limit price of $142. My estimated credit is $141.97 because again, Robinhood took 3 cents from me when we sold it back to the market. So all in all, Robinhood took a total of 6 cents. They took 3 cents when I sold it, and they took 3 cents when I bought it. So I like how Robinhood is now getting transparent with their fees. So that is how you would read the filled order contract. And that is pretty much it. We are going to do a lot more of these breakdowns that are more complex, but I wanted to do an easy one for the first one just to kind of get you guys better understanding what you're looking at. All right, so there you have it. We broke down my options contract step by step, bit by bit. I hope that this helped anyone that was struggling with understanding how to read an options contract. I will be doing more contract breakdowns, and I will also be doing more profit breakdowns as we continue on with this channel. So if you like this video, make sure you give it a thumbs up, subscribe if you're not already, and I will see you guys in my next one. Bye.